is one of the second important things that we do. I'll say that because obviously we have to do the journal entries first. Once we do the journal entries, what we do is then we put the information into the income statement. We take the information from the income statement, do another set of journal entries, which is the closing entries to close out the income statement into retained earnings, and then we close out the retained earnings into the balance sheet in the equity section. So the way the book presents it is with the balance sheet first, and it's kind of, you see why. It all kind of goes back to the balance sheet, right? Up to this point, we've just pretty much known that you have a revenue, you credit it to make it increase, and you, if you have an expense, you debit it to increase that debit expense. Now we're going to see what it's like to do an income statement. Previously, what we've also done is said all revenues minus all expenses are equal to income. But what we're going to do is we're going to look at the statement in a format that we'll prepare it for basically the rest of our lives, which means that we have an exam and we also have regular life. We also look at these things. So we want to get familiar with why they do what they do. A lot of times, if we just memorize stuff, it won't make any sense, okay? So we're going to go through basically not every line, well, actually probably every line, but more so why certain things in a certain way, okay? This is maybe not necessarily what I'm going to say, but when you see things that are indented, we do want to pay attention to those things that are indented because they are indented for a reason. Most likely, to show that you're adding or subtracting something separately and then putting a total in another line. If you can have this little computation area on the side, then if you mess up, you can always go back and change that and put the right answer in. So that's one of the advantages of doing it this way. But of course, for other reasons, it just makes it look a little bit better, okay? So let's start with the income statement. The income statement is basically, we know revenues minus expenses. But now we want to do is we want to talk more about the revenues and we want to talk less about the expenses. The reason I say less is because expenses, they generally speaking don't follow in order, generally speaking, but the expenses that you see at the top are usually the ones that are going to repeat over and over and over again. You only see things like operating expenses here. This can be broken out in future places, but in general, these are operating expenses, but the expenses you see at the top are generally those that will occur more than one time, okay? So let's start here. Let's talk about revenues first. This chapter, number one, the whole book is based on us owning a business, right? So we have to remember that perspective. Now we're going to think about us and our revenues. With our revenues, if we have a business and we're selling things, we have to do what? First, go and buy the stuff. We agree? Even if we're just going to cut a yard or cut hair, whatever it may be, we have to buy clippers. We have to buy fuel for the engine. We have to buy everything that needs to be done for those things. So we buy that stuff, okay? Now, our job is to make money. We agree? So if we buy something, are we going to give it away? No, we're going to have a little markup, and that's fair. A lot of times, just a tip, especially if you're in a service business. I know there are some construction majors in here. If you decide to go into general construction or not general, into being a general contractor or something like that, there are people going to ask you, well, let me see the cost for the receipt. I could have gone and got that at Lowe's or Home Depot. No, that's your job. You go and buy that, and you have a reasonable markup, because that is your material. So you're buying. You didn't go and ask Lowe's how much they paid for it, right? You went and paid what it was. So you will have a slight markup on those materials as well. Same thing. Let's say if a young lady is getting her hair fixed and she wants to have a relaxer or something like that put in her hair, what she'll do is if the person is doing her hair, they'll go buy that tub of stuff, and that's going to be in your price of what you pay, right? Well, you didn't go ask Sally's how much they paid for it, right? You just bought it. And so your customer will try to ask you for those things, but remember there's going to be a markup associated with it, okay? Now, all this stuff we buy is inventory. You got it? Construction majors, you're buying things for your inventory that you're going to sell. There was a gentleman wanted to own a gym at one point in time. Let's say not so much the gym, but if he owns a juice bar, he may have all this equipment, these nutritional items that he wants to sell to his customers. We have that stuff we buy as inventory. Inventory is that current asset that we're going to use to sell stuff. You remember that? Okay. Now, when you sell stuff, you're going to pay a price for it. The inventory this is a question, is the inventory in the income statement or balance sheet? If it's in the balance sheet, nod your head yes. If it's in the income statement, nod your head yes. Good. Inventory is in the balance sheet, okay? Inventory is in the balance sheet. Now, When you sell inventory, you're going to remove that inventory from the balance sheet, and you're going to have to record it in the income statement, okay? So that's something we need to be aware of. We'll have inventory in the balance sheet under current assets, and once I take that hair product out, once I take that those construction materials out, once I take that nutrition stuff out, when I take it out and sell it, I'm not going to put it back in there because I've sold it. I have to put it somewhere else. So I'm going to put it in my income statement. Now, just to make sure we don't get it confused, we're going to call it a different name. We're selling things, right? We have these goods that we want to sell, right? And we paid something and it cost something to us. That's going to go from being called inventory to a cost of the good that you sell, okay? That's a cost of the good that you sell. So when we talk about cost of goods sold is really just an expense. It's the biggest expense. And the one thing you know about accounting is that we want to make sure that everything we do, we categorize it, right? We want to put it with stuff that is relative to another. So to make sure that we do that, what do? Since these things are directly related to what we sell, we put the cost of goods sold separate from our regular expenses, okay? Is everybody good so far? Now let's talk about the revenues, because this is where most of your journal entries are going to come from. And since they'll come from there, it's best that we understand it. Just a quick review. Our revenues are increased by a debit or credit. Is it by debit? Nod your head. Do we increase revenues by credit? Nod your head. Good. We increase them by credit. So everything we do to increase revenues is done by credit. Sometimes we call these things sales revenue. It may be called sales. Other times, if you're doing other stuff, it may be called service revenue. If you have things like at this school here, or most schools actually, you have, I'm just using the name, I think we'll get it. You have revenues from academics and you have revenues from athletics. Does it make sense? Your revenues will always be named by what we want to name. Yes, ma'am.
So with the revenues, since they always increase by credit, with the journal entries, that's what I have the hardest time about.
Okay.
With the journal entries, the expense will always be the top one for the debit, and the revenue will always be the bottom one that's indented for the credit.
Yeah, I like how you said that. The quick answer is yes, but I want to repeat with what you said. Her question was, if we have revenues and we have expenses, do we always credit revenues? Which she knows that answer. She said yes, but I think she was saying, may you put that on top probably, and then put expenses on the bottom? Is that kind of what you were saying?
Like, what I was asking was, is it always going to be expense revenues, or is there any possibility to swap?
They could be swapped depending on what's going on. I think if we talk about the revenues, then the expenses will come easier. And the expenses are kind of like, you're always going to have an expense. So generally speaking, you'll never swap an expense unless we made a mistake. Obviously, we make a mistake, we want to correct that, right? But generally speaking, we won't switch revenue. We won't switch expenses, okay? So your expenses, once you set that expense up, it is always debited. Let me help understand why. One of the things that we talked about that we have with accounting is the matching principle, right? It is March. It is March. Last month was February, right? Everything we sold in February, we need to record everything in February that we sold, right? Remember that? So everything that we had to pay for, we need to make sure that we keep that in that month as well. So any expense that we had in February will stay in February. Once you record that expense, that is it. So let's talk about a big expense, because this is going to answer your question, but it's actually a link between the two chapters I think will be helpful. If you have an expense, right, and you record salaries expense, if you're not going to pay it till March, then you will do what? You will credit salaries payable. That is a liability. We agree? Now, why do we do that? We do that. We record the expense in February because that's when it occurred. Think about it. Let's just say Christmas was we'll take Valentine's Day. That was in February. Valentine's Day was in February, right? So you probably stocked up on workers, or you probably did a lot of different services. You want to finish something for somebody by Valentine's Day, right? Now, you want to finish it, and you did finish it, but I'm not going to pay you till probably about the 15th. In about 5 days, I'll pay you, right? But the work was done then. The reason that we record expenses then, as like I said, the work was done and we want to keep it there. But in order to make sure that we keep account of all the things that happened, we have a liability that we had an accrual for. That's the link that's right there. We accrued that liability there, and because we accrued it there, that means that we will no longer have to worry about that expense being put any other month. Now, you will pay me this. I will pay you this month. Okay, we'll pay the employees this month, and we will remove that liability. But that expense is never credited. Once you put that expense in for a debit, it always stays, and so it won't even come off the books. So you won't ever have to worry about it being swapped around as well. Does that kind of help you out a little bit?
So it would be like the debit would be the salaries and wages
Expense. That's right. That's good.
and then the credit would be
Salaries and wages payable
payable.
for that month, only, or if it's by week, for that week, for that month, for that week, for whatever period it is. Okay, I don't care if you pay them in November. That expense has to stay right there. Why is that important? Now, let's think about why it's important. Because next year for Valentine's Day, you want to. I had this many sales. I had this many people. I want to make sure I hire the right amount of people. Let's just say that you recorded the expense in November when you should have recorded it here. You may go, look, my sales were down last Valentine's Day. I'm not going to stock as many people. You don't have as many people because your accounting records weren't right, and now you don't hire enough people, and you either lose business, you can have theft because you don't have enough people there. So accounting helps us to make decisions, which is why we accrue all of that, and accrue means to record the effect without the cash impact, even though we're going to pay the cash later on. So once you put that expense on, it's not going anywhere. And that's another reason we're doing it last, but it's a good link what you said to talk about it. So every expense, every operating expense, even cost of goods sold, these other expenses and losses, which we'll talk about later, all of those are designed to make sure that it is, as we see here, for the, in this case, year ending such and such. If it was for a month, it would be for the month ending. And that way, once that's over with, it's over. It's done. Okay?
So in simplicity terms, expenses can go with other things such as payables and stuff like that, but expense will always be debit. and
Expense will
revenue
always be, that's right, expense will always be debited, and revenues will always be credited.
And revenues will always be with expenses if it's on there.
No, that's a little bit different. That's a little bit different. Even if we think about it like this, where it gets to net sales here, everything above that has to do with revenues. Everything below that, generally speaking, has to do with expenses. Okay, I say generally because we talk about others. That's a little different story. Okay. Now, I like that question because one thing doesn't change, as we just said. We do not take expenses off the book. That, unless we made a mistake. We understand that, but we're not. That's not the mistakes we're talking about. Out there somewhere else. That never comes off the book, so we're fine with that. Now, for revenues, we make sales and we credit revenues, right? We credit revenues in order to show we had a sale. But what if I return something? What happens? What if I return something? Then you don't get to say you have revenue for that, do you? Right? So you need to remove that. Now, here's the key. You sell something to me because it's your business. You sell it to me. Initially, you credit your revenue. How do we take revenue off the book? If you give me a wrong answer, that's okay. I think that if you give me the wrong answer, you'll never forget it. So if we put revenues on, if you give me the right answer, that's great too. If you put revenues on the books with a credit, then how do we show that we take revenues off the books? By debiting what?
Payable?
You say
Payable?
payables? I'm gonna get three answers.
It's the one where you're owed, whenever someone's paying you.
Some liability. Let's say some liability, okay? So one answer is a liability. The other, I need three answers. The other answer is what? The other choice, I should say, is what? Think of it as a multiple choice. If you credit revenues and put them on the books, right? You have to debit to something to take it off. We agree, right? What will we debit? One choice is a liability. What's another choice?
The assets.
The assets, okay. I can see where that comes from with cash. I can see where liabilities come from. And it's good you're thinking because even though we don't have multiple choice questions in here, when you're taking other courses and other exams, you want to make sure that you think through these things, okay? Because why are they putting these answers here, okay? So I can follow why you say that. How about I give you the third answer, okay? Now I'm gonna make a sing out this so you don't ever forget, all right? I'm telling you, I'm gonna make a sing, so I don't want you to forget. Don't get scared, okay? When you put revenues on the books, you do it with a credit, right? When you take it off the books, you have to debit something. When you take revenues off the books, You do not debit revenues. I told you to make a scene, right? You can never forget that, right? You do not debit revenues. Please don't do it. Don't do that, okay? Don't do that. The general reason why is because what? I need to know. It's accounting, right? I just want to keep up with what I'm doing. If I put revenues on and take them off, at the end of the day, yes, I do have the right amount, but I can't keep up with it. Instead, I want to make a new category that's called sales returns and allowances to talk about, to show that I'm taking them off the books, okay? So instead of debiting, let's go back from the beginning. You credit revenues for the sale, right? When I return something to you, do you debit revenues? No. You debit sales returns and allowances. This is what we debit. Now, when I go back next year, I can see I had all these revenues, then I can see how many returns I've made. See, I got a different category now for the same token. If most of the time people give a discount because stuff is not selling, right? So if you have a discount, you sell it for $100, but I give you a discount of 5%. We need to keep up with the 5% discount that we gave. So we don't just put, well, we could technically put $95, but instead we want to record the revenues. We want to record the revenues, and we want to record the sales discounts in a separate account called sales discounts. So with revenues, when someone returns something to you, you never credit revenues. You never credit revenues when somebody returns something to you. You always credit sales. You always debit sales returns and allowances. Whenever someone returns something to you, you never debit. I should say you never debit revenues. You always debit sales returns and allowances. Okay. So just to say this here, if you make a sale, then you credit revenues. If someone returns, if it's a return, then you debit, for abbreviation, sales, return, and allowances, okay? If it's a discount, then we debit discount as well, okay? So that's very key. That's key. That's key when we get to the actual journal entries. Okay. See, this type of problems you have on the exam, they're just going to give you these things here, and then they're going to say, "Give me an income statement," and you just go fill it in because that's all we can really do. Period. Okay.
Debit what?
Debit discount, debit sales returns and allowances. Never credit revenues. Never debit revenues. Excuse me. Never debit revenues to show a reduction in revenues. Okay. You'll credit sales. You'll credit revenues for making a sale. If someone returns it, you will debit sales returns and allowances instead of revenues. If you have a discount, you will debit sales discounts instead of revenues. Please just don't debit revenues, okay? And now, obviously, if you accidentally select the wrong account, that's one thing, okay? But if you are trying to make that, you never would debit revenues, okay? Okay. So what do we never debit? Revenues, unless we just don't know, we write something down, we erase it. That's like, and do something like that, or later on. But to show that return allowance, and that we're going to see that when we do the journal entries. But I do want to make that point. Now, when we're looking at our income statement, we can look at that a little bit more in depth because we have pretty much the gist of everything. But I want to go through this right now with the income statement, okay? It starts off with sales. The same way we start off with balance sheet, current assets, and then long-term assets, we start off with sales, okay? Sales, revenue, all right? If you think about the statement of retained earnings, when we subtracted something, we always said less, correct? So sales revenues, which in this case is, it's not all going to fit on here, so let me see if I get as much on here as I can. For sales revenues, you have $743,000, which you would have credited. In real life, you may have 2 or 3 revenue accounts. Don't worry, you'll add all of them up and then put one number in, okay? Less our sales returns and allowances. That means that somebody returned something. In order to make sure that we keep it in the same period and understand what's going on, we're going to debit that. Now, I know this is indented, but don't think of these indentions here as debits and credits. That's just kind of, it just has to be in a certain place. They could have very well put it on the other side, but that would not have looked as nice, okay? So these are not saying debits and credits because it's left or right. It's just that all of your totals generally go to the farthest right side, and then your subtotals usually go in the middle right here, okay? So sales, in particular, sales revenues, 743,000 in this place here, less my sales returns and allowances and sales discounts, is going to give me my net sales, okay? It's going to give me my net sales. 743,000 minus 8,200 minus 2,700. That's my subtotal, but my net sales are right here. Okay, so sales minus or less sales returns and allowances minus or less discounts gives me my net sales. What does net sales mean? That is, net sales is simply the sales that I made when I take into account my returns and discounts. Think of it like this. Let's say you get paid $30 an hour, right? Do you take home $30 an hour? No, we take home something after we pay our taxes. What we take home is our net pay. So it's our $30 an hour less our net pay. So this right here is our total sales less our returns and discounts for this particular period only. If for some reason they made a sale on January the 3rd, you are not to go back in and put this sale over here, okay? That would be wrong. If you do it on purpose, that'd be really, really wrong, okay? So we don't do that because it's important that we know how much we sold it last year. And then if people are investing in us, say if you invested in me and you want to know what my sales were last year, what if I come telling you about how much I made the first couple? That doesn't matter to you, right? You need to know what I did last year, okay? Because who knows, the environment changed this year. So the income statement is always for a period ending. Is everybody okay with the revenues right fast? Take a second to think, and if you have a question, that's no problem. Just has anyone tried it yet? Don't worry if you haven't, okay? We'll get some in next time, okay? So any question with the sales? We have our sales. We increase our sales with a what? A debit or credit? Do we increase them with a debit? Nod your head. Do we increase our sales with a credit? Nod your head. Good, okay? We increase them with a credit. In order to, I'm going to ask this question two different ways. This is going to drive home the point. In order to offset, in order to show, in order to demonstrate our sales returns and allowances, do we credit sales returns and allowances? No. We debit sales returns and allowances, okay? We debit it. We do not debit the revenues, okay? Yes, ma'am.
One thing we can always know for certain is that the sales return and allowances and the sales discount will always be debit and the revenue will always be credit.
Correct. Why? Because we're not supposed to take that. Let's say this is December 31st, right? If sales are final for that month, if sales are final for that month, we can't go back in and adjust those revenues, but we can adjust it through these accounts right here, okay? That helps us. That helps us to know how much and when things will return, okay? That helps us to gauge how much inventory we're going to buy later on, because as we see right here, all these sales were made based on our inventory that we took out of our shop here, and we sold it, whether it was sold it to a person for a service or selling them an actual good. We gave that we sold it, and the cost of that was this right here, okay? Now, in real life, you have a markup, right? But just understand for right here, this inventory, this is this cost of goods sold represents our inventory that came out. So cost of goods sold represents our what? Say it again. Cost of goods sold represents our inventory, right? What's cost of goods sold represent? Inventory. Good, because we have to make sure we know that, because we're going to have some journal entries that's going to require us to do that later on, okay? So this is just our inventory that we took out. And sales minus cost of goods sold will always give us gross profit. How's everybody doing so far? Everybody okay? All right. Everybody good, question-wise? And some may come up in a second, okay? All right, so now we just have our expenses. Now, this is going to be a lot of different things. You can have general expenses, selling expenses, rent expense, utilities expense. A lot of different expenses are going to go here, okay? One that will not go in these expenses right here is the income tax. Why is that true? Because we pay income tax on our gain, for lack of a better word. Let me not use that word. We pay income taxes if we have more revenues than expenses. We agree? So if I put my expenses up here, it can only be based on what my revenues were. So our operating expenses only include those things that make our business go. That is it. I always use a school because I think that's the easiest way we can understand this. With the school, we agree that I hate to say it, but a school sells education, right? You get down to it, a school sells education. So any expense that has to do with selling education is going to be an operating expense for a school, okay? That means anything from these markers to these here, buildings, you won't call it an expense, but certain payments if you're leasing, that may be one. Salaries for people, tables, work study expenses that you have for you. Those are types of things that, because if you didn't have a work study, you probably couldn't afford to go to the school that you want to. So that is an expense that must be paid. Okay, so anything for the school, selling and education, that is going to be an operating expense. We okay with that? Come make a distinction. So we good with that, right? And think about this on your exam, why certain things go a certain place, or when you get out in real life, because a lot of us like to do 2 or 3 different things, right? But we have this main thing we do, and everything else is everything else. So for the school, anything that has to do with selling the education goes under what? Operating expenses. We got that? So these net sales, let's just say this is sales from tuition. This is how much tuition was collected. This is not a tuition number, but we're just going to act like it was a school because this is an easier example than what we have here. We don't know what this company is. They don't even tell us what they do, okay? But we know what education is, so this can apply. This is the education. These would be, cost of goods sold would be maybe, let's say they sold you books. Just say they sold you that. That would be a cost. And then you have your gross profit. Your expenses are anything that has to do, your operating expenses are anything that has to do with that, okay, with selling the education. And then we get our income from operations. What operation is the school in? Selling education, right? So that is the first part of the income statement, and that is where I want to stop for a second to see, do we have any questions about that? All right, so far, we're talking about selling and education, right? Selling and education. All that goes up here in our sales minus our operating expenses gives us our income from operations. This is key. Please don't miss this one because we need to know what our income from, in this case, selling education is, right? If we had a construction business, income from constructions. But we're using school because we're all here and we can make a better distinction about that, okay? Now, can we keep going? The school sells education. They also sell athletics, right? Now, if this was a big school, like or a school that had a really good football team or really good basketball team, they could make a lot more from those sales than they could make from the university, right? We agree. I mean, you talk about 100,000 seat stadium for some places. That's more than an NFL stadium. And so for them to have that, they could technically make a lot more. But what is the school in? What should the school be in business for? Selling education, right? So everything that has to do with selling education goes with sales, revenue from education sales, and also it goes with the expenses associated with that from selling education. Everything else is an other type of revenue or an other expense. Why? Because we need to be able to look back and know how much should I price tuition. Oh, well, we got all this revenue from football team and basketball and baseball. That's nice, but the education business has to take care of itself, right? Construction, you may do the construction, but then you may come by and you may also want to do a gardening business. You can make more money possibly doing gardening than construction, right? But what are you in business for? Construction. So you need to understand that's your main business. And yes, you can invest in the stock market and make more. You can invest in the stock market and make enough to retire if you hit it big, right? But that's not income from what you do. That's other income. Now, at that point in time, I don't care what you call it because I'm gone once I hit that, that big one, right? So, but the point is, if you're going to keep going, you want to be able to predict these things. So we want to make sure that we know that everything above Income from operations, that only has to do with why we're in business, the money we made because we're in business. That's what that has to do with. Everything else is other revenues and gains, other expenses and losses, okay? That's what we have up here. For example, we have some of this stuff down here, but we have to come back and fill in some blanks, okay? These green ones are places that I know we have to fill in some blanks, but other revenues and gains, that would be stuff like, once again, this building here, they rent this building out from time to time. That doesn't go under tuition revenue. That goes under other revenues from renting this building out. Same thing with that building right there. Same thing with the football stadium. All that's other revenue if we're talking about a school. And yes, you can make more money with that. You still have to take care of your business and make sure that is good, or you can shut that business down and go into it full time. If you could, I don't think a school can shut down a school and go into athletics, but if they could, that may be what would happen, okay? So other revenues and expenses is anything that doesn't have to do with your normal course of operations, what you do. All right. Then we get our income before taxes. Notice our income before taxes is going to be our income from operations and our other income, which is right here, the 18,000. They don't have a name for it here, but you can just say income from operations, and then you take this amount, our revenues minus the expenses. That net amount we have there will give us our income before income taxes. In this case, it's $266,400. All right. Now they don't give you anything here in terms of how they got this income tax expense. Well, excuse me. You have a 25% income. You have a 25% income tax. You can only calculate this number correctly once you have this number correct. So basically, you'll take this right here, 266,000, multiply, put in your calculator by 0.25, and that would be, in this case, 66,000. Since it's 25%, you can just say, if you ever see a tax rate 25%, you can just take your number and divide it by 4. Okay, so you can do it the way I said it, or you can just take this 266,400 divided by 4. You'll still get the same thing. If it's a 10% tax rate, you just divide it by 10. Those are just some easy ones that we kind of always, they go into 100 really easy. I wouldn't. You can't do that for 40%, 27%, 11%. Just those are two easy ones you normally would see. 10%, and you probably see 25%. Just divide it by 4 or 10, depending on which one it is. If you don't feel comfortable using that calculator, okay. Everybody still okay? So all we did, this place right here, they gave us some things, but then we had to go back and fill in others. And we had to fill in 1, 2, 3, 4, 5, 6, 7 accounts. But this was to make sure that we understand that these other revenues are not supposed to be up here with our regular ones. Why? Because these other revenues are revenues from the football stadium, if that's what we were doing, okay? If it was a school, this could be, once again, it could be way more than tuition revenue, but it must be kept separate, okay? All accounting is, once again, is making sure that we keep things separate, all right? Any questions on that? Everybody good?
So the only things that will be in the top, like with the income statement where the revenue area would be?
Yes.
The only thing that's ever gonna be there is the sales return and allowance and the sales discount. Anything else is gonna go to that bottom line.
Don't forget your revenues. You're going to record your regular revenues at first. So we have to have something to subtract it from. Well, usually you have to have something to subtract it from. So we do want to make sure we have our sales revenue, and then we subtract what you were just talking about right there. You probably already knew it, but it just makes sure we lock it in our head. Sales revenue less or minus returns and allowances, minus returns and discounts. Okay.
What is the whole
Net sales.
thinking of a income statement, there's like the revenue and there's the expenses, which is under it.
Yes.
What's that third section?
Okay, this right here, or is this
The income before taxes, because that is still a part of where.
okay, this line right here. I'm gonna make it. Let's see if we can make it smaller and you can still see it. If not, it's okay. Okay.
Just that third chunk, because you see how there's like an empty space.
Okay. Let me walk through it. This here, all of this, the name is kind of self-explanatory, so don't worry about it. All of this is our net sales minus cost of goods sold is gross profit. So let's draw a line. If you could draw a line under gross profit, okay? That would be, let's call that section 1, okay? Let's call that section 1. That's your markup that you made before you have any other expenses that associated with it. So let's call that section 1. This is not won't be in your book, but if we want to, I think that's a good way to check it. Let's think of it as section 1. Okay, section 1 is your gross profit. Now, everything else I do is going to add on to that. All right. You remember a second ago we had this income before tax. This income from operations right here. Income from operations. This is going to be our gross profit minus all of our operating expenses. I stress all because there's obviously more than one. But once again, salaries and wages payable, utilities, expenses, rent, whatever it is, it's a regular expense that's going to be there. So we have our gross profit, section 1, minus operating expenses will give us our second section, which is income from operations. But remember, now we're just extending that to that box on down, okay?
So that gets subtracted instead of added?
Which part? The operating expenses get subtracted from your gross profit, okay?
Like with the lines, net sales minus cost of goods sales.
That's correct. Net sales minus cost. Okay, net sales.
That would equal gross profits.
Net sales minus cost of goods sold equals gross profits. That's correct. Minus operating expenses
And then
will give us,
that would equal income from operations.
right.
So you're just subtracting everything on here?
Yes. Keep in mind that sometimes you may have to go in and add up expenses. They want us to get the concept on this one right here. Usually these brief exercises, you just have one thing. In this case, they want us to understand the concept, okay? So that's the only reason we're doing that. It's just for concept purposes. But yeah, sometimes you may have 3 expenses, 4 expenses. You add all of that up, and then you'll put that in and subtract it. So when I say add it up, you may add up right here and then put that in that little box right there to the side.
Is the reason why we subtract everything is because it says less on the top, that just goes for everything under it, or just the...
In this case, less. In this case, it is. This down here, we just know that we don't add our expenses to our revenue, so we have to subtract it. If we had some more, I think it'd probably be even evident because you have that list over there, and then we would subtract the others. That's probably the reason that it looks funny right here because we don't have a list of expenses out here.
And even like the third section just gets subtracted as well? Or the third section, the third chunk?
Keep on going. You keep on going down. Okay, now, so we're gonna draw a line right here, right? Now this here, we subtract the net amount. 20,800 minus 2,500 gives us this right here, and that will be subtracted. So let's scoot over so we can see these numbers here. Yeah, we can see more of them now. We had 248,000 minus 18,300 and something. That is the difference between these right here. Okay, so we got the difference here, and then we subtracted that. So 248 minus 16 gives us 264. How do we get this 18? From our football sales right here, if this was football, okay? From our other business that we had, okay? All right. And once we have that, then we can figure out how much we pay for taxes. That's 25%. And then we have a net income or net loss. Either way, where does that go? It goes in our statement of retained earnings, right? Let's do a quick review. We credit revenues to increase them. So how do we get the revenues from the income statement to retained earnings? We simply take them off the books only this time for closing interest with a debit, and then we credit it to income summary. And we do the reverse for expenses, and then we take the income summary and put it into retained earnings, okay? So that's our income statement in terms of the what it's for. Sometimes we'll be given other things, but it wants to stress. If you want to write this down, the reason this problem is here, number one, our brief exercises, they want to test a quick concept. And so these are the concepts they want to test. Or not test, but to make sure that we get in our line and our understanding. They want to make sure we understand that everything above here is income from what we do, the school tuition revenue, and everything below is from any other business we have, whether it's stock investments, whether it's the football stadium we're talking about right here. It could be whatever investment, whatever we have, that goes somewhere else. So that's why they have these two. The reason we want to have our cost of goods sold separate, they're putting us in is so that we can understand that that's how we get our gross profit. That's why we can see, have we marked up, think about it, have we marked up our goods enough so that we will have some type of profit, okay? So have we done that? The best way to do it is to know where our cost of goods sold goes, which is right here after our net sales, okay? The reason we have our sales discount, and I can't highlight both of them, so sales discount and sales returns is so we can understand and remember that we never debit revenues. We have to have something else. Why? Because we want to keep up with what we have. And then our operating expenses, that obviously is subtracted. So that's, if you want to know why we did it, that's why we have those there. So when you're doing these, it's going to come a time you can probably pretty much memorize these. Then just say to yourself, this is why I did it, okay? So any questions on the income statement part right fast? Yes, sir.
How do you find income tax expense?
Income tax expense, okay, that's at the bottom, right? All right, let's go, it's at the bottom. You have your computer up by chance? Keep your computer at the bottom, and I'm gonna scroll to the top and look up here, and we're gonna see it. So I think at the bottom you have, what do you have? Well, on the bottom here, I think we had 266,000, I think here, let's see. We had 266,440, right? $400. So write that down or put that in your calculator for a second, okay? $266,400. That's how much income we had before taxes. And we want to understand why we have the income tax expense, right? Well, think about it like this right here. Let's think about next year, because this year is already done. We don't know what the tax rate is going to be next year, right? They're going to have to tell that to us. So either they're going to tell us they're going to tell us two things: the percentage, and they're also going to tell you that this is how much this little piece, that's how much you're going to pay regardless. So the reason I say they're going to tell it to us is because that information is going to be usually given up here somewhere. In this case, they tell us our tax rate is 25%. So I know that whatever income I have, 25% is going to go to the government, right? So out of my 266,000, how much of that is going to go to the government? You can give me an answer in one of two ways. How much is it going to go? Huh? 25% is one way to say it, or you can multiply by 25% and give me that answer. Either way, I think I like the way you do the 25% because that might, if it's 35, okay, I multiply by 35. If it's 10%, I multiply by 10%. Okay. Yep. Okay. Good deal. Okay. Good question. Once again, we can't do income taxes first because remember, income taxes is after we know all of our revenues and our expenses, including these right here. Only after we get our income before taxes. But think about it. If we have a loss, we don't pay taxes, right? Now, I wouldn't recommend you trying to have a loss unless you're trying to have less taxes. But make sure you do it correctly, meaning that you didn't try to have a loss. But in the event you have a loss, let's say that you had, I'm just throwing out something. Let's say that you had a gain last year, but you have a loss this year. If you have a loss, then guess what? You can actually get back a portion of the taxes you paid. So remember that. Okay, so up to a certain amount, and then if you can't get that back, the laws change. So I'll tell you to look at the tax laws, but they're called, you want to look to this net operating losses, okay? Net operating losses, and you'll get a portion back. The rules change so much I don't keep up with them because I don't teach the tax or I don't even do my own taxes, okay? I get someone else to do it because that's out of my category for right now, okay? I could do it, but I'd rather someone who does it do it. Like a head doctor a foot doctor can tell you what's wrong with your head, but I probably rather go to the head doctor, just to be on the safe side. So I like to let that person who does it all the time do it. But that tax rate will always be given to you, so we don't have to worry about guessing. Or they may just say income tax expense. If that's the case, don't worry about computing anything, okay? All right. Everybody good so far? Well, that's the income statement. That's what we have for the income statement.